just high level, there are going to be 2 journal entries for every single sales transaction. Okay, so this is the big difference between if you're buying inventory versus selling inventory. Okay, selling is going to require that you do 2 different things. Okay, number 1, account for the revenue. Okay, so that's going to be 1 journal entry. And then the second one is going to be accounting for the buy low part of it. Okay, so look, this is our 1 single sales transaction. Okay, we're selling some amount of items. Here is 1 journal entry where this is how much our customer is paying us. It's either going to be account receivable or cash, depending on what happened in the transaction. It will tell you. So you're going to debit that, and you're going to credit sales revenue. Okay, this is how much your customer has paid you for, let's say, 10 items. You paid some amount for those 10 items at some point in time in the past. Okay, that's what this is going to be representing. This is your cost for the same items. So you're going to take them out of inventory. So it's going to reduce your inventory balance, and you're going to expense it as cost of goods sold. So if we look at the T accounts, we had some amount of inventory. We're selling some of it, right? Maybe this is like 100 units. We're selling 10 or whatever it is, however many. So you have to, now we know this is now 90 units at this cost. We have the revenue. So all this stuff is, it's all linked. It's here, this is here, and then we assumed accounts receivable. So that's all the T accounts from here. Okay. You can also offer discounts, right? Just like your vendor offered you a discount, you can offer your customer a discount. Okay, so you're going to see these same nomenclature, it's the same formatting, but now you are offering it to your customer rather than you being offered it from your vendor. Okay, so it will look the same, but now you're like on the other side of the trade. So your assumption is that you will not take the discount when you record the sale. Okay, so when you first record the revenue, you'll assume that they're going to pay you the full amount. And you're only going to record the discount if they pay you, if they actually avail themselves of it. Okay, so you can see here, you're going to use this sales discount. It's a contra account. Okay, so you initially recorded the sale of 5,000. I guess we're starting with this, but you obviously you're not going to get 5,000. They're only going to give you 4,900. So that 5,000 of revenue is like not. It's like you can't show all of that in your income statement because you didn't actually get that much. So you have this contra account called sales discount. Okay, so this is another. I mean, this is like the first taste of like it's I guess the second taste. The first difference between you being the buyer versus the seller is that when you're selling, there's 2 journal entries. The second is when the discount is taken by your customer, you're going to have to use this contra account called sales discount. Okay, so you can see here that these 2 are related, right? This credit balance and this debit balance are going to offset. So your net revenue, and you saw that in those financial statements we looked at, they just reported it said net revenue, right? Because they're accounting for returns, discounts, all that stuff, and they're only reporting this kind of net revenue because that's actually the real revenue. This is a contra revenue account, so it's going to be in the income statement. Okay, so your account receivable needs to go to 0. So again, this is the case where your customer took the discount. Okay, you offered them a discount. They're going to avail themselves of it and not give you the full amount that the sale was for. Okay, so again, they're going to get 2% discount. So 5,000 times 2% is equal to $100. That's where this is coming from. So you're going to get this much cash. The account receivable has to go to 0 because they no longer owe you any money. And to make the journal entry balance, you need more debit. It's going to be $100 to this contra account. And so when you then group all this together, it's going to balance. It's going to actually show how much revenue you collected. It doesn't matter what that beginning point in time is, because let's say, like, just to be like totally, if you wanted to scam someone and you weren't accounting for it like this, you could be like, hey, I'll sell it to you for $10,000 and give you a 90% discount, right? So your income statement, if you didn't do this, you could show I had $10,000 of revenue, even though if the person took the discount, you're only going to get 1,000, you know? So the net revenue is actually the important number. It doesn't matter what that initial undiscounted amount was. We could have, you know, hypothetically just done this. You could have just debited sales revenue when someone took the discount, because remember, when we originally recorded it, we said we're having revenue of 5,000, but if they take the discount, then we're not actually going to receive 5,000. We're going to receive 4,900. So we could have just done this, and this would have went to 4,900. But we basically want to track the discounts and the returns we're going to see. We're going to track them in separate accounts. Why? Is there some information in that? What if you have a lot of sales revenue, but then you have a lot of returns? What could that mean? Yeah, your product sucks, right? It breaks a lot. It's like of poor quality. Okay, so there's some information in keeping these accounts separate. Okay, a financial management, your financial statement readers, they may want to know these different things that happen, right? Because again, like sales returns, there's some information and how much that was as a portion of your revenue. Okay, so if you just tracked everything in sales revenue, you're going to kind of net all that stuff together and you're going to lose that. So we're going to track it separately in separate contra accounts. So we have sales discounts. We're going to have another contra revenue account called sales returns and allowances. So we're going to track all that in different accounts. Okay, good. Okay, so again, we have the same thing with sales returns and allowances. There is a difference now, right? When we're talking about purchase transactions, a return. Does anyone remember what the difference between a return and an allowance is? Who remembers what the difference was? So with purchase transactions, there is no difference in the journal entry between those two scenarios. When you are the seller, there is a difference because in allowance, you're not getting that inventory item back. Okay, versus a return, you are getting it back. So if you're giving an allowance, you're basically not going to have this second journal entry. Okay, so you can see here when we have a return, so this is a return, okay, we're getting that inventory item back in inventory. You can see this asset is going up. We don't have a contra expense account for cost of goods sold. We just directly credit this, right? Because again, cost of goods sold is an expense account. Its normal balance is debit. But in this case, when we have a return, we're gonna debit inventory to account for that item coming back, and we're gonna credit cost of goods sold because we no longer have that expense, right? We're kind of undoing part of the sale. Okay, and then kind of here too, it's the same. We do have a contra account for returns, as I mentioned. So we're not just debiting sales revenue, but we are also reducing this account receivable for the balance because this person is no longer owes us for this item that they're returning, right? So we got to reduce their account receivable. So you can see it in the T account here. We started off with 2,000. That was the original sale. They returned half of it. So they now only owe us for that other half that they've kept. Okay, so accounts receivable, check, that's fine. Sales revenue, we originally recorded 2,000. And again, uh, half of that is not revenue anymore. So really, we need some debit here of 1,000. But instead of putting it directly into this account, we don't do that. We have this contra account that has the debit. Okay, so again, these two net together. So our net revenue is 1,000. So that's correct, right? When we take the account with its contra account together, that gives us the correct number. Inventory, we're adding back that 750 because this is a return, right? The allowance is not going to have this part, but since this is a return, we're saying it's a return of half the order. We're going to add it back in. And the cost of goods sold, this was the original. So our original profit or kind of transaction was 2,000 revenue, 1,500 cost of goods sold. Half of this cost of goods sold is coming back. So now we're kind of, we have now the correct $1,000 of revenue and the 750 of cost of goods sold. So the key thing to remember is when you're purchasing inventory, returns and allowances are the same. When you're selling, it's going to be different depending on whether it's a return or an allowance. Okay, so if we again, if this was instead of customer returned half, it was customer you gave the customer an allowance for half, you would just not have this part because you would not have gotten that item back. Okay, so you still had that cost of goods sold. You're not going to undo that expense because you paid for that item and you're just kind of giving it away for free. So that's still going to be an expense for you. Okay, you are only going to have this transaction for an allowance. Okay, freight expense. Okay, so again, this is another difference between whether you're purchasing or you're selling. Okay, so what did we do with freight costs when we were paying for inventory to be delivered to us? What did we do with that freight expense? Does anyone remember? Exactly. This terminology it was capitalized. Okay, it's some outflow, but we're treating it as an asset, right? It's going to go into inventory, which is an asset first, and then it would be expensed when it's sold. So cost of goods sold, you can technically say this is not just how much we paid for the item, but it's like including all the freight and everything, right? We're gonna expense it at that time, and it's gonna be some methodology because let's say you paid $50 per unit to buy it, and there is a freight charge of whatever $100. If you bought 1,000 units for that, you could divide up the total freight by 1,000, and that's like your all-in unit cost. You'd have to figure out a methodology to split the expense of the freight when you're purchasing it to say how much each item cost you all in, right? So there'd be some methodology, but I guess in general, what I'm trying to say is that cost of goods sold is kind of the total cost of your inventory, including freight. That's how much you would expense when you sold it. Okay. Um, but when you're selling the item and you're paying for freight to deliver it to your customer, you're going to expense it right away. It's part of it's like a service you're providing to your customer. Okay, so that's an expense because the revenue for that sale you're recording at that time, it's like you're also providing this extra service to them. And so you're going to also expense that at the same time of the sale. Okay, does everyone understand the timing difference here? When you're buying inventory and paying for freight, it's the associated revenue has not yet happened, so you're going to keep it as an asset. When you're selling the thing and paying for freight, the revenues happen, right? This expense is part of the sale, you can say. It's like paying a commission, you can say, if you had a salesperson. So this is like an immediate expense that you're going to take because it's part of the revenue. Okay, so we're going to record it as a selling expense. Okay, so this is separate than cost of goods sold. It's not related to how much you paid for that inventory. It's like this extra service you're providing for your customer. That's what you're expensing.